Hello, this is Kevin Prince from BMO Exchange Traded Funds. Welcome back to the Market Insights webinar. Thank you for joining us this week. And like we do each week, we try to give you some insights towards the market as well as specifically on exchange traded funds. I also want to thank those people that took the time to send us some questions because those questions help drive our content on a regular basis. And we're going to dive into one of the topics we hear from the past, which is technical analysis today. But before we jump into the topic, let's get through the traditional disclaimers. Number one, we're not going to provide specific advice, nor are we going to provide specific recommendations. What we really want to provide today is give you some insights in market, focusing today on technical analysis. And I'll say that one more time on behalf of our partners here today, which is BMO Investor Line. Same thing for BMO Investor Line. We're not going to provide specific advice, nor are we going to provide specific recommendations, but we do want to give you some insights towards ETFs specifically and around the markets itself. So with that, let's bring the guests in today, and a good collection of people today. Number one, Alfred Lee is going to join us today. You've heard from Alfred in the past, but you may not have known that Alfred is what they call a CMT. That's one of the designations he holds. And that's a chartered market technician. So he's going to focus a lot and share some of his skill sets in regards towards technical analysis today. Mackenzie Box coming in from our product management team. Thank you for joining us, Mackenzie. And I'll highlight that I think it actually might be Mackenzie's last day today because she's going to go off maternity leave. So thanks for joining us today, Mackenzie, and sharing your insight and wisdom as always. Chris Graham has joined us from Investor Line. He's got a special offer to offer to everybody today, so we're going to get to that in a little bit. Before we get to that, though, we always like to start off with a little bit of insights to the overall market, what's going on out there, specifically in ETF. And we've recently went through the month end, so we know the flows are out, what happened at ETF through flows. And Mackenzie, can you walk us through what happened in flows last month in April as some indications into itself?
Sure, and I think even just highlighting what's happened so far this year has been really interesting. In April alone, ETFs saw 4.5 billion in flows, and year to date we've seen almost 18 billion, so just over 17 billion in flows in ETFs, which is pretty outstanding. And I think we're looking like we're on track for a big year. I think as people look and start to realize the benefits of ETFs and the accessibility of them as well. But what's interesting when you dive down a little bit deeper, we did a show a few weeks back on Canada where we've, kind of all the different options you can invest in Canada, whether you want to go factors, whether you want to go broad exposures, whatever the case may be. But when you look at our equity flows just in April and even year to date, you've seen a huge influx of money coming into Canadian equities, which I think is really interesting to highlight. And then as well, one of the other things that I think we're seeing lots of, and I think a lot of interest in, is crypto assets. So obviously there's been a large influx of money coming into crypto asset types, especially within the ETFs, as people look for easy ways to access those. And then one other area I think that really stands out when we look at where some of the flows have been coming is technology. And I will highlight and do a bit of a plug that we did do a webinar on NASDAQ a few weeks ago. But I think with the pickup that we saw in technology last year and, all the news and the buzz that we're hearing about tech, we've also seen a lot of money get allocated to technology as well.
Thanks for that, Mackenzie. Always appreciate your insights, and you get to utilize that around the flows itself, because that is a good indication where people putting their own money to work, or the institutions too putting their money to work across the board. And special thanks to National Bank for sharing those charts. Hey, Chris, let's turn to you because you have a special offer to offer the audience. So talk to us about that.
Thank you very much, and happy Friday, everybody that's listening today. We do at Investor Line have two promotional offers that we'd like to highlight on this call today. The first one being our Advice Direct services. These are our online advisory services that's personalized for your investment needs. what we have available now is our promotion that can get you up to $2,500 in cash promotions should you want to set up. Again, our Advice Direct service is our directed for those customers looking for maybe a little bit more fundamental research. So we also have our second promotion available to our self-directed investor line customers. Anyone that's interested in opening up a new account can get the $4.95 trades on equities and ETFs. Currently, the offer, how it stands, is if you do open up a new account under our promotional code situation, you would type in Invest Smart, just like it says on there, all one word, and you'll be getting $4.95 trades for the next 90 days. So those are the two promotions that are available right now through both of our services. Again, we love to highlight our top research analysis tools that are available to all of our customers, as well as your own customized benchmark portfolio tracking tools that are available online. You want to go to the next slide?
Talk to us about those briefly there. Yeah, the Investor Line Market Pro, please. Yeah, sure.
Yeah, so this is our service is one of the top of the line investment tools for technical analysis. Is our Market Pro services. You will be able to get real-time streaming charts using advanced inter-day technologies to customize your own technical studies. So you can, I think there's over 100 different technical studies that you can apply to all of your accounts. Add multiple different stocks or ETFs to the ability of overlapping and doing incredible different studies that are available on there for you. And again, it is real time and you're able to actually trade on the charts themselves. So I do encourage any customers that are interested in learning a little bit about our Market Pro services. You can find out additional information on our website. And if you have any questions or concerns, my contact information will be at the end of the presentation, and I'd be happy to answer any of those questions for you.
Thanks for that, Chris. And I'll highlight to the audience, we're going to use a few of the charts today will be actually done through Market Pro to show you some of the power of that tool itself. Now, one more tool, and I have to do this because it's Mackenzie's last day. She's been working on for the last 4 months on a new tool that's about to hit. Mackenzie, talk to us about the new tool that's going to be on BMOETFs.com.
Sure, it's something we've had the ability to do for quite some time, but we've just made some great enhancements to it, and I think it's a lot more user-friendly at this time. So what it really is a stock replacement tool. So you want to find out all the ETFs that hold a particular stock. Well, we have a great tool to help you do that. So I think now we've cleaned this up. We've cleaned up a lot of the data. We've made it very user-friendly for you. You simply type in whatever stock it is that you want to look for, and the results will give you all of the ETFs listed in Canada that hold that particular stock. And then you can sort by the amount of exposure a particular ETF has to that company, or whatever the case may be. If you want to look at the fees of the ETFs, the AUM, whatever it may be, you can kind of slice it and dice it whichever way works for you. But I just think it's a great way, especially as we see a lot of people looking for particular companies, whether it be in tech or if they're looking for banks, whatever the case may be. It's a simple, easy way to find out ETFs that work for you and will help match your investment guidelines.
That's perfect. And highlight that for the audience. If you go to BMOETFs.com, you'll see a button there that says tools. A lot of people go to the comparison tool. This we're talking about here is the new stock replacement tool, will be under ETF Screener. I encourage you to take a look, play around with it a little bit, might help you out to get an insight on a certain ETF that might meet your needs. And I should know it's not just BMO ETFs, it's all the ETFs in Canada be listed there. Mackenzie, stay with you. Let's kick into the topic here. You know, we certainly hear a lot about fundamental analysis. What is technical analysis? Walk us through that.
Sure. And I think when you look to tracking the market or looking at different ways to analyze the market. Fundamental and technical analysis are kind of the two major ways you would approach that. Fundamental analysis, really looking at companies, so evaluating stocks by measuring their intrinsic value, whereas technical analysis looks at the price movement based on previous price movement. So it's looking historically and forecasting future financial price movement based on what's happened in the past. So they're just different ways of looking at the market. And really with technical analysis, it's just looking, what's done historically, and then this can be used against stocks, indices, ETFs, whatever the case may be. And Alfred will get into that a little bit more later on.
So let's just dive into one of the key things to think about when you utilize ETFs for technical analysis. That's our focus today, ETFs for technical analysis. You can certainly type in an ETF as a ticker into a technical analysis chart, but one thing people tend to see is volume. And I know people have been told to utilize technical analysis is look for volume to confirm. Mackenzie, talk to us a little bit about why we should be cautious about using volume when it comes to an exchange traded fund. We got this slide, and I can move to the next slide too if you want me to.
Sure, I think, one of the biggest things too when you look at ETF volumes is you want to make sure you're looking at consolidated volume as well. In many cases, it's not giving you a consolidated quote, so you're only seeing a fraction of the underlying volume. So that's also something you want to be mindful of. And it's not, the volume of the ETFs is likely not the same as the volume of the underlying. So you always want to remember that ETFs are based on the underlying, and they are created and redeemed, so there will be a bit of a difference, but it's always based on that underlying.
Exactly, and that's one of the reasons why I'm probably be cautious about utilizing that volume as an indicator in technical analysis, specifically around ETFs. And here's a little chart. Maybe you can walk us through this about liquidity of an ETF and why that's maybe different than a stock where people normally use the volume as an indicator for.
Yeah, I think when it just goes back to kind of what I was saying in the sense that, an ETF is based on the underlying. So, the respective volume for, here's an example of ZEB, all the Canadian banks versus the respective volume on ZEB is very different. Obviously, it's a reflection of it, but it is very different. So the one thing you want to be mindful of too when you are looking at ETFs is, yes, looking at consolidated volume. And you can always measure it versus your underlying, but it is going to be different.
Thanks for that. Good cautionary note. So let's get into the core topic of today, because we're going to talk about ETFs as indicator around exchange trade funds. I'm going to bring Alfred in, and we're going to talk about different ways to use ETFs for that intermarket analysis, the broad market indicators, fixed income for that matter too, and even sectors and securities on top of that too. So let's dive right into it. Now, Alfred, let's start off with kind of more of a proof point here, right? And this is a proof point kind of highlighting that you can use ETFs as an indicator, just like you use indexes. Talk to us about this.
Yeah, so I think, one of the benefits of using an ETF above an index is that with an ETF, you get a lot of additional information as well, right? So, when you're looking at an index, for example, typically what you get is the index levels at close. So that gives you a lot of detail, but by looking at an ETF, because it trades throughout the day, you have a lot of intra-market kind of behavior throughout the day that gives you additional insight, right? So for example, let's say if you have an economic release jobs number in the US, which tends to have a pretty big impact in terms of how that affects the equity markets. By looking at past behaviors and how the equity market has behaved throughout the day, by gleaning that information through an ETF, that does give you additional information above and beyond just the index. So this is a good chart that highlights this. So when you look at the top of the chart, this compares ZUE, which is the BMO S&P 500 ETF hedged back to the Canadian dollars. You can see it overlaid on the S&P 500. It almost looks as if it's the same line. There's actually two lines there, but that tells you how closely the ETF will track the underlying index. And the same thing for ZDJ, which is the Dow Jones ETF. tracking the index essentially just looks like one line. So that's, as I mentioned, it just tracks the index, but with an ETF, you get additional information above and beyond the index. So one thing I would urge you to consider is that, when you look at an ETF, do look at an ETF that does trade or does have a lot of liquidity. And the reason why is because if it trades throughout the day, you're going to have additional price points throughout the day. Typically, the larger ETFs tend to trade more often, given that there's more users. So, with more liquid ETFs, it's equally liquid as, those ETFs that don't trade as often. But, the good thing is that you get additional information just by those additional trade points throughout the day, especially for, investors that do a lot of day trading.
Thanks for that, Alfred. Now let's talk about intermarket analysis now, but utilizing ETFs. What do you mean by intermarket analysis?
So intermarket analysis is a branch of technical analysis. Personally, I think this is a type of technical analysis that a lot of people don't use. So when a lot of investors think about technical analysis, they think about drawing lines on a chart or looking at some of the oscillators, some of the momentum indicators. Intermarket analysis is actually more applied to the bigger picture. So looking at the relationships between 4 types of assets or asset classes. So there's equities, fixed income, commodities, and currencies. The reason why is because those different 4 asset classes will have different behaviors, right? Equities perform well when the economy is expanding. Fixed income tends to do well when the economy is contracting or when there's deflationary pressures. Commodities tend to do well early stage. Economic expansion tends to do very well during inflationary environments as well. And currencies, depending on which currency you're looking at, US dollar tends to be more of a risk-off currency. Canadian dollar, because of our commodity exposure, tends to do well when there's a lot of risk-taking in the market. So, by looking at the relationships between, let's say, equities and fixed income, you can glean or you could get a lot of additional information above and beyond just looking at individual stocks. So by knowing, what's going on in the bigger picture, that's going to allow you to have better, potentially better decision-making abilities when you're picking individual stocks or picking ETFs.
So let's do an example here. For example, you mentioned equities and fixed income. So here is one of the examples you put together on equities versus fixed income. But there's also a concept here, if you can share with the audience, relative strength too, as you discuss the chart.
Yeah, so relative strength is, one of the technical indicators that we covered in our last technical analysis webinar, which was a couple months ago. But it's a very good tool. Essentially, what it is it compares one asset to another. So intermarket analysis is actually a type of relative strength, but relative strength could be applied to not just asset to asset, but it could be applied to many different relationships as well. But when you're applying it to intermarket analysis, what you're doing is, as I mentioned before, comparing one major asset class to another. So what we did over here was we compared SPY, which is an ETF that tracks the S&P 500, AGG, which is an ETF that tracks the overall US bond market. So by knowing the relationships between the two, that's going to give you, again, additional information above, what you get from individual stocks. So by looking at the chart on the top here, what you'll see is, when COVID, started becoming an issue in February of 2020, what you see is that ratio or that relative strength start to break down. You see a gap down there. So that, as you can see, that ratio is going down or becoming, a lower number. That means bonds are outperforming stocks. So there's a risk-off sentiment in the market. Similarly, after March, when the market bottomed on March 23rd, what you see is that ratio essentially increase. So that tells you that is a pro-stock environment. So it's beneficial to be in stocks for the most part when you see the relative strength of equities outperforming bonds.
Thanks for that, Alfred. And then, keeping through that, keeping on top of the topic of intermarket analysis, another thing a lot of people take a look at and maybe share with the audience here is those moving averages and what those can do to help you through that intermarket analysis.
Yeah, so we, just discussed the relationship of, the example we gave was stocks versus bonds. But you could get additional information just by looking at a quantitative signal, just which could tell you more timing tools, just in terms of letting when to get into a position or when to get out of a position, or you could use these moving averages to tell you when to add to a position, or even pare back a position as well. So moving averages are a good indicator for this. There's different types of moving averages that you can use. So the most common one is using the 50-day and comparing it to the 200-day. People that use a 50-day, it's a fast enough indicator where it's not going to get, you're not going to get whipsawed by daily kind of moves, but it's fast enough where it does tell you, it is fast enough to get you information to get in and out of a market. So the typical indicator that a lot of people use, or how they apply this, is comparing the 50-day average compared to the 200-day moving average. So when the 50-day moving average crosses above the 200-day moving average, that's what they call the golden cross. So that means that is a signal to get into the market. And at the same time, if a 50-day moving average crosses below a 200-day moving average, that's what they call a death cross. A little bit of an ominous name, but that is a signal to get out of the market. So when you look at it historically for a trending market, it does tend to work relatively well. Obviously, this depends on the characteristics of the market. You tend to miss the bottom of the moves and the top of the market tops as well. But what a lot of people do in this case is they shorten the shorter term indicator to a 20-day to make it more reactive.
Good indicator into itself, absolutely. Alfred, you were telling me earlier on that ETFs provide more insight. Maybe you can talk to us a little bit more about that additional insight you're getting from ETFs.
Yeah, so a lot of times when people look at say their nightly news, and the reporter will say the Dow Jones was up 1%, the Nasdaq 2%, and then TSX 3% or whatever it may be. A lot of people just look at the absolute moves in terms of how one index will go up over a certain period of time. What an ETF, if you look at the constituents of an ETF, so the individual stocks in an ETF, that will give you an additional insight as well. So by looking at not just how much an index is up or down, but you want to look at how many stocks are participating in that market rally. So let's say if a market rally is driven by 5 stocks in the index only, that's typically not a healthy rally. When you see that, that means a market rally is losing strength, and that typically is a good indication of when the market might sell off or consolidate a little bit. But at the same time, if you see a rally where most of the stocks in the index are participating, that tells you that it's a healthy rally. And the same thing, when the market is selling off and you see certain stocks start to participate or trend the other way, that gives you additional insight in terms of the health of a rally or the magnitude of a sell-off as well.
And then let's keep going here, because you also brought in one of the longer, more known technical analysis theory out there is Dow Theory. Talk to us about that as another indicator of the marketplace.
Yeah, so Dow Theory, as we were saying before the call, this is a pretty old school kind of method, but I still think it bears a lot of weight in today's market. So how the theory goes is that there should be a relationship between the Dow Jones Industrial Average, which is made up of more industrial related stocks, and then there is the Dow Jones Transportation Average, which consists of a lot of transportation oriented stocks. So think of cargo liners, railways, those sorts of stocks which transport goods. So how the theory goes is that typically in a healthy economy, you should have both of these indexes moving in line with each other. Once they start to diverge, that will tell you, or is a good indicator of when the market will soften or when the economy will potentially turn as well. So the theory goes that if you have, let's say, the Dow Jones Industrial Average continuing to move up, but then the transportation average is moving down or diverging on the way down, that tells you that potentially the transportation stocks are no longer transporting goods to the end distributor. So a divergence in one of the averages tells you a potential turning point in the broader market.
So let's flip gears here because we talked about equities and we talked about technical analysis on equities. Let's flip gears for a little second here and talk about it on fixed income now. What kind of additional insights you can get on a fixed income basis through looking at the ETFs in the marketplace and a technical analysis lens?
Yeah, so I think a lot of people, when they look at technical analysis, they apply it to stocks. What a lot of people don't know is that technical analysis is actually a broader tool that could be used for other asset classes as well. So not just currencies or other asset classes like commodities, but it could actually be applied for fixed income as well. So fixed income, a lot of people say that the fixed income market is actually a better tell signal than the equity markets, given that it tends to get more of its call right than the equity market. So even looking at technical indicators in the fixed income market, that's going to potentially give you information on how the stock market will behave. So when you look at fixed income sectors, for example, so when you look at the Canadian market, what we like to do is break it down by the component parts. So meaning that you break the fixed income market into short-term bonds, mid-term bonds, and long-term bonds, and then each of those three buckets into more granular pieces. So federal bonds, provincial bonds, and corporate bonds. And then when you get that, that's what we call our 3x3 matrix. So those components within the 3x3 matrix will have very different, risk characteristics. So when the market's selling off, long federal bonds tend to outperform because you essentially have a flattening of the yield curve. But then when the economy starts to expand, what a lot of people do is they start shifting their exposure into short corporate bonds, just because the yield curve is steepening and credit spreads are tightening as well. So on the chart on the left, what I did here was I compared the short corporate bond ETF from BMO compared to the long federal bond from BMO as well. So this essentially is relative strength of the two ETFs. So what you'll notice is that over the last several months, the short corporate bonds started to outperform, meaning that that is a risk on market, meaning that you can you could infer this into the equity market as well, telling you that it is a pro-equity environment. And then if you overlay a quantitative indicator on top of that, so the 50-day moving average and the 200-day moving average, that's going to give you an additional tell signal in terms of when to get in and out of that trade as well.
Thanks for that, Alfred. Now, going back into the equity lens, one thing with inside equities, of course, is sectors. And we got a couple of slides coming up now on sectors and how you can use ETFs to analyze sectors. Give us your insights first on that, Alfred.
Sure. So, with the, we talked about a lot in terms of technical analysis, how it applies to ETFs on the broader market. So, a lot of people that are accustomed to using ETFs will know that ETFs represent a lot more than just broad market representation. There's sector ETFs as well. So when you look at when the market rallies, typically somewhere after the early stage recovery, what tends to happen is that sectors within the market start to deviate, and certain sectors will start to outperform others, as we've been noticing over the last couple of months. So typically what you'll find is that the stock market tends to be a leading indicator of the, what's going on in the economy. So at different stages of the economic cycle, certain sectors are going to outperform the others. So early stage outperformers tend to be financials as the yield curve starts to steepen, and people will start, spending more money on discretionary goods. And then, there's more industrial expansion. And then, as the economy starts to recover, and there's more of a need for things like copper as people start building houses and buildings. And at the top of the cycle, energy starts to perform well as people start to do more travel. But then as the economy starts to contract, people start moving into needs rather than wants again, and reduce their discretionary spending. And then the market starts to gravitate towards more steady eddies such as healthcare and utilities. One thing I will point out is that every recession is going to be different depending on what drove the recession and what drives the expansion as well. But typically, this tends to be the sector rotation strategy. But again, every recession is going to be different.
So let's go through a couple examples specifically in the sectors here. So for example, looking at XLY versus XLP, which is staples versus discretionary, and the bottom line there is the relative strength of the two. Give some insights in that there, Alfred.
Yeah, so this is a good one, just in terms of looking at sector rotation. As I mentioned, when you look at consumer goods and consumer discretionary or consumer staples versus discretionary, they tend to be very different just because, discretionaries are, needs or, wants rather than needs. People tend to be, needs rather than wants. So as the economy starts to expand, people start having more discretionary money to spend on discretionary items. So looking at the relationship between these two ETFs or indices, that's going to tell you, how the market is behaving when the relative strength of discretionary starts to expand relative to staples, as we can see in the bottom of this chart. What that tells you is that it is a pro-risk environment, meaning that people are taking risk, and that tends to be good for the broader equity markets.
So then the other thing you can do when it comes to sectors too is you can look at, and any particular market for that too, you can look at the respective seasonals, and that's of course looking at the trends of certain asset classes over periods of time. In this case, XLY versus XLP, staples versus discretionary, and you can see that there is sometimes a seasonal pattern. Might give you insights. Now that pattern is going to change from year to year. That is something you can look at too when you look at on a sector base across the board, and maybe the broad market too for that matter. Alfred, I want to stay with sectors for a little bit more here, because you can do things like equal weight versus market cap when you talk about sectors. Talk to us about that. Did I lose you there, Alfred?
So this is a good example because with an ETF, there's different ways of constructing an ETF. There's a market cap weighted ETF. There's equally weighted sector ETFs as well, and the characteristics are going to be slightly different. So for example, with an equal weight, using applied to the Canadian REIT sector, this is a good example where it tends to be a very heavily concentrated sector where names like Allied Properties and RioCan tend to dominate that index. So RioCan is an office retail REIT, where Allied is an office property. Obviously, those two have been hit pretty bad by the COVID lockdowns. So looking at the relationships between the equally weighted, which tends to de-emphasize those larger weightings, and then comparing it to the market cap weighted, that tells you how that sector is behaving, and the impact on the broader market as well. So as you can see from here, the equal weighted has outperformed, which means that a lot of the stocks within the REIT index that have been better protected by better insulated from those COVID lockdowns have outperformed during that period.
And then my last one for you there, Alfred, is in regards towards using ETFs as kind of a benchmark now to individual securities. Talk to us about that in utilizing technical analysis.
Yeah, so as I mentioned, there's different ways in which you can apply things like relative strength, not just asset class to asset class, but you could also use it to a more granular level. So individual companies relative to a broader ETF as well. So over here, what we did was we compared the Bank of Montreal and TD Bank. So individual stock compared to ZEB, which is the equal weight bank ETF, compared to ZEB, which is the equal weight banks ETF. So by looking at a group set, you can get further information in terms of which outperformers you have relative to a specific sector.
Thanks for that, Alfred. And just another way of utilizing ETF in this case now is a benchmark. So thanks for that, Alfred. Thanks for sharing your wisdom on technical analysis, in this case, specifically around exchange traded funds as a tool of technical analysis too. Chris, let me come to you. Let's get from you your closing comments here regards your digital codes for those people who want to take up your offer.
Thank you very much again for everybody for joining. Again, if anyone's really interested in speaking about how InvestorLine can help with all of the wonderful information that we were presented today, our investment offer stands in that promotional code when opening up a new account. If you're interested in taking advantage of the 495 trades, again, that promotional code is InvestSmart, just how it's spelled on the screen there. And then if you're interested in learning more about our Advice Direct advisory services and would like to open up an account to receive our promotional offer there, the digital code, it would be, or the promotional code is digital09. Again, if anybody has any questions or concerns, please feel free to give me contact there below. And thank you again for having us on the call today.
Thanks for joining us too, Chris. Now, my favorite part, we're gonna take some questions that we had sent us before. We may not be able to get through them all. We're running a bit late here, so I apologize for that. You know, Mackenzie, let me turn to you. Individual attends our webinars. Thank you for doing that on a regular basis. Had some fluctuations the last little while in regards towards some ETFs. Share some thoughts around that.
Sure, thanks, Kevin. I think one of the biggest things you want to keep in mind is an ETF is a reflection of the underlying, right? So you always want to be mindful if the underlying securities in that ETF are going down, the ETF is going to reflect that performance because it's a basket of those securities. So always keep in mind that. The other thing you want to keep in mind is your time horizon. When did you buy? And then as well, looking at your longer term horizon, or how long do you want to hold this ETF for? Is this a long-term hold, or is it a short-term, more tactical movement? So just things you want to keep in mind. You're always these things are gonna follow the underlying. You are gonna have ups and downs in the market, but just keep in mind your time horizon, what your investment objective is, what you're trying to achieve, and then always look at the underlying securities within an ETF.
Thanks for that, Mackenzie. Alfred, let me finish up with you. The last question. It's in regards towards gold. It's not rebounded yet. Why is that? Because sometimes you see the market move and ETF and gold go the other direction. Give us some thoughts on that if you can.
Well, the thing I always say is that, and the good thing about gold is that it's a hedge against many things. But the bad thing about gold is it's a hedge against many things as well. So when you look at, but the bad thing about gold is it's a hedge against many things as well. So when you look at gold, it's a hedge against the U.S. dollar, macroeconomic risk, and inflation. So even though inflation risk has started to pick up, what's been going down is because of the vaccination of COVID and the optimism of a reopening market. Macro risk has gone down. So that's why a lot of people that have been using gold as a hedge against macro risk, that money is starting to come out, which is why we've been seeing some weakness in gold.
Thanks for that, Alfred. And I'm very much apologize for not getting a chance to get through all the questions today. I will make sure that we send those people an email answering your questions directly. Thank you for doing that. And please keep sending your questions in because we didn't get a chance to get all of them. I want to highlight, we're not going to be on next week. We're going to take a little bit of a break, but please, can you join us again on May 28th at 1 p.m. Our topic for that week will be on healthcare and genomics. So we're going to dive into that as a concept to share with everybody out there and give you some kind of consideration around that. Last note for everybody, this session is provided for information purposes only, and any reference to a particular company or product is for illustrative purposes only and should not be considered investment advice or recommendations to buy or sell. Particular investments, of course, and trading strategies should be evaluated based upon an individual's objectives and seek professional advice where it is warranted. Thank you so much for joining this week and look forward to you joining us again in just 2 weeks' time. Cheers.